One of the hardest things about dividend investing is figuring out the right companies to invest in. And if you're new to the game and don't know where to start, trying to do this can make you feel like you're just blindly throwing darts at a board hoping for a bullseye. Which is why in today's video, we are going to build the perfect dividend stock portfolio with just 10 stocks. Now, our goal with this portfolio is to create something well diversified. So because we're only choosing 10 stocks, we're going to want to have exposure to a wide range of sectors and industries. This will help us reduce risk because things won't be too overly concentrated in one individual company or one individual area of the market. Along with that, we also want this portfolio to be one we can count on. And obviously we want to ensure that it performs well because we're trying to beat the market here. So we'll be choosing to invest in bigger blue chip companies that are more recognizable household names and for the most part have a history of outperforming the market. And with that said, it's important to mention that what's happened in the past may not repeat itself in the future. So a company that has historically outperformed in the market may not continue to do so moving forward. It could, but there are no guarantees. Anyway, because this is a dividend portfolio, we're also looking to invest in companies that have a track record of making consistent dividend payments, which they're increasing every year. And many of these big blue chip companies offer that and have done so for quite a long time, as we'll see here pretty soon. Now, the first couple of stocks in our perfect portfolio here will be coming from the consumer staples sector, which is one of my favorite sectors to invest in, and you'll recognize a lot of the companies in this sector. As the name suggests, these companies build their business around products that are not very cyclical in nature, so they're pretty much always in demand no matter what's going on in the economy, which makes this a pretty stable and defensive sector to invest in. And as you can see here, some of the companies that make up the consumer staples sector are ones like Costco, Coca-Cola, the Hershey Company, Pepsi, Procter & Gamble, and Walmart, just to name a small handful. And while I think all of these companies are great ones to own, for our portfolio here, we're going to invest in Costco. This is just a beast of a company. Costco's membership revenue is a huge competitive advantage that they have over most of the other grocery retailers out there, and this has helped generate really solid and consistent growth in the company's financials over the years, which is likely to continue as time goes on. And looking at their dividend stats, the growth is certainly present here as well. Although Costco has a really low starting dividend yield, they are growing this thing pretty aggressively with a 12% 5-year dividend growth rate, and they've been making consistent increases to that dividend for nearly 20 years, which is exactly what you want to see from the companies you invest in. You want to see that consistent growth. Anyway, in addition to Costco, we're also going to invest in Procter & Gamble, which is one of my favorite dividend stocks out there. What I love about Procter & Gamble is that they make things people use every day and will need to buy no matter what. I'm talking things like toothpaste, laundry detergent, deodorant, diapers, paper towels, toilet paper, and so much more, and all of their brands really are the cream of the crop. Now, as far as the dividend stats go, the yield and the growth rate here are pretty moderate. They don't really jump off the screen, but what does is that dividend growth history. Procter & Gamble is one of the most consistent dividend growers out there with a 67-year growth streak, which is twice as long as I've been alive, and that makes them a dividend king. Overall, in my opinion, it doesn't get any more sleep well at night than these two companies right here, Costco and Procter & Gamble, which is why I think they'll make for great additions to our perfect portfolio. Now, still in the realm of consumers, we're going to jump over to the consumer discretionary sector, which is made up of companies like McDonald's, Starbucks, Lowe's, and Home Depot, which are all fantastic companies, but tend to be a bit more cyclical than those in the consumer staples sector. So we'll see some more ups and downs with these companies depending on what's going on in the economy. And I really don't think you can go wrong with any of these companies. I personally own a couple of them on this list here, but out of the bunch, we are going to go with Starbucks for our portfolio, which is another one of my favorite dividend stocks. As a somewhat frequent Starbucks customer myself, I just know how religious people are about their Starbucks. And I know it's $7 coffee, but for many people, it's part of their daily routine. And it's like a key element for survival. The daily trip to Starbucks is a hard habit to break. Now, looking at their dividend stats, Starbucks has all the makings of a classic dividend growth stock. The yield is pretty standard at 2.5%, and the 5-year growth rate is looking nice and high at just under 10%. Not to mention, they've been growing this thing for the last 13 consecutive years. Now moving on, we're going to take a look at the technology sector, where there are two very dominant companies that come to mind, and those are Apple and Microsoft. Now I really don't think you can go wrong either way, because both of these companies have just obliterated the market these last 10 years. And I know many investors like to have either one or both of these companies in their portfolio, but for our purposes here, we're just going to rock with Microsoft, which is a fantastic company. They're involved in many different areas, and they excel in pretty much everything they do, from software to cloud services, gaming, social media, and now even artificial intelligence. They pretty much dominate every field they're in. Now, as far as the dividend stats go, this is another low yielding stock like what we saw with Costco, but what they lack in yield, they certainly make up for in growth, with a 10.2% 5-year growth rate and a growth history spanning almost 20 years, and I'd be hard pressed to believe that this growth won't continue for many more years to come. Anyway, next up, we're going to take a look at the industrial sector, which is a really fun one, because even just within this one sector, there are so many different ways to diversify, because it's made up of just a ton of different industries, many of which are important to our national and global infrastructure. And there are a lot of great companies to choose from in the industrial sector, like Snap-on, Union Pacific, Deere & Company, Lockheed Martin, and Waste Management, just to name a small handful. And even just out of this bunch, it's going to be hard to choose just one. But for our portfolio here, we're going to go with Waste Management, which I think is a pretty safe one to own, considering that the demand for trash collection is as consistent and permanent as it can get. I can't imagine what could come in and disrupt a company like Waste Management. But anyway, concerning the dividend stats, as much as I do think Waste Management is just a fantastic company, I've got to admit the dividend stats from this company are the least exciting that we've seen so far. The yield is definitely on the lower end, coming in at just a hair shy of 1.5%. And you think that with a yield that low, you'd see a high double-digit dividend growth rate, but nope. All you get from Waste Management is about 3.4%, and they've only been growing the dividend for the last 4 years. Still though, dividend stats aside, Waste Management has been a solid grower over the years, and I think that will continue as time goes on. Now over here in the communication sector, guys, we've got a few different options. We could go with Verizon, we could go with AT&T, or we could go with Comcast, which is going to be our pick for the portfolio today. Not only has Comcast outperformed the other two by a long shot, but as far as the financials go, Comcast is the better grower, and it's also a more profitable company, which probably explains the better performance and should bode better for the dividend as time goes on. And with that said, I think Comcast has the best dividend stats out of the bunch as well. Their yield isn't as high as what you'd get from something like AT&T or Verizon, but the dividend growth from this company is looking fantastic, with a near 9% 5-year growth rate, and the dividend growth history is a work in progress, coming in at 6 years. Speaking personally, I just recently sold out of AT&T and Verizon in my portfolio, but if I ever got a wild hair to jump back into the communications sector, Comcast is a company I would certainly consider checking out. Now jumping over here to the financial sector, there are a couple different directions we can go with this one. We can choose to invest in a bank like Bank of America or JP Morgan, or we can go the credit card route and invest in something like Visa or MasterCard. And in our portfolio here, we're gonna rock with Visa. I'm like obsessed with this company right now. And out of the handful of different payment networks that exist, like Visa, MasterCard, American Express, or the others, Visa is by far the largest and most dominant out of the bunch. And as people pay for things with cash less frequently and continue to buy things more with their credit cards and debit cards, the value of Visa's network will increase and the business will continue to grow. And because Visa is so profitable with an insane 45% free cash flow margin, as the business continues to grow, so should the dividend, I think pretty aggressively. At least this has been the case so far with Visa. Like we've seen with a few companies today, the dividend yield isn't the highest, but that dividend growth rate is off the charts, guys, at 16%, and they've been growing this thing for the last 15 straight years with no signs of stopping now. Now, our eighth stock today will be coming from the healthcare sector, and there are a lot of great ones to choose from, including pharmaceuticals like AbbVie, Johnson & Johnson, and Pfizer, along with other healthcare companies like United Health Group and Humana, and it's honestly pretty hard to narrow it down to just one because there are a lot of good companies in this sector. But out of the bunch, Johnson & Johnson, which is one of the most legendary dividend stocks out there, will be our go-to. Johnson & Johnson has a wide-ranging portfolio of pharmaceuticals and medical devices, and overall is one of the more defensive expensive and long-standing companies in the sector, having been around since the late 1800s. And looking at the dividend stats, you can see why this is such a legendary dividend stock. The yield and growth rate are both pretty respectable, and that 61-year growth streak is hard not to get excited about. We've got another dividend king on our hands with Johnson & Johnson. Now, for our second to last stock, we'll head over to the energy sector, where we'll want to go with either Chevron or ExxonMobil, and I think they're both really solid options. Both of these companies actually were formed from the remnants of Standard Oil, which was broken up back in the early 1900s and split into over 30 different companies, one of which was Standard Oil of California, which later became Chevron, and another was Standard Oil of New Jersey, which later became Exxon. Anyway, guys, for our portfolio here, we are going to go with Chevron, which historically has been the better performer of the two by a long shot, and they have the advantage in the dividend department as well, with a near 4.5% yield and 36 consecutive years of dividend growth. And Chevron is also the one that I have in my own portfolio, so I may be a little bit biased with my selection here. And now, guys, this brings us to the 10th and final stock. And for that, we're going to jump over to the real estate sector and look to none other than Realty Income, who is the monthly dividend company. Now, Realty Income has a huge portfolio consisting of over 13,000 properties, and they lease to tenants in 85 different industries, with all of their largest tenants being companies that are pretty well insulated from changing consumer behavior, like Dollar General, Walgreens, 7-Eleven, FedEx, and Walmart. Now, like I mentioned a moment ago, Realty Income is the monthly dividend company, meaning that they pay a dividend every single month, and their dividend stats in general are just pretty top notch. As you can see here, they have a really nice and high dividend yield sitting just below 6%, and they've been growing this thing for the last 26 years, so they've got it down to a science. And owning Realty Income is almost like a rite of passage for dividend investors. I think you'd be hard-pressed to find a dividend investor who doesn't have Realty Income in their portfolio. I'm sure some of you guys out there don't, but I would wager that most dividend investors do own this company. It's one of the most popular dividend stocks out there. But anyway, guys, with the addition of Realty Income, this is going to be our full 10 stock perfect dividend portfolio. And you can see here, I've accounted for an equal weighting of all 10 stocks here. So each one is given 10% of the portfolio. And in doing so, this is going to leave us with some pretty nice dividend stats overall, I'd say. The yield is pretty moderate, coming in at 2.44%. And the 5-year growth rate's looking pretty nice as well, just above 8%. So a nice high dividend growth rate. And like I said earlier, this portfolio of stocks here has historically generated market-beating returns. So if you would have invested in this portfolio over these last 10 years, just these 10 stocks, you would have crushed the S&P 500 by quite a bit. Now over here, guys, using the portfolio visualizer tool, which will allow us to do a back test of this portfolio and see how it would have historically performed, we're going to look at the period over the last 10 years. So January 2014 to the end of February of this year. And you can see that right here, guys, we have all 10 stocks from top to bottom, Comcast all the way down to Waste Management. And if you would have invested $1,000 in this portfolio 10 years ago, and then from there invested $100 every single week, your final balance today would be $131,539, which is fantastic. And this is also about $20,000 more than you would have had if you would have invested in the S&P 500. Furthermore, during the good times when the stock market is roaring and everything's going up, you would have generated a higher return than the S&P 500. And on the other hand, when the sky is falling and the market's not doing so hot, your portfolio would have seen less of a drawdown than the market as a whole. And we can see that over here looking at the best year and worst year. In your best year, you would have generated a 36.66% return, which is about 5.3% above the S&P 500. And in the worst year, your drawdown would be about 12.4%, which still outperforms the S&P by about 6%. And then, guys, if we take a look at the annualized returns, on average, every single year, this portfolio would have generated a 16.23% return compared to the S&P 500's 12.5%. So on average, every single year, we would have outperformed by close to 4%. But all of that, guys, was just the past until now, and that type of performance may not continue into the future as time goes on. We'll have to see what happens. But still, I think we should take a look into the future and maybe try and guesstimate what this portfolio might look like 20 or 30 years down the road. And to do that, we are going to be using the marketbeat.com dividend calculator using the same inputs that we had from the backtest. We're going to start with an initial investment of $1,000, and every single week, we're going to invest $100 $100 into this portfolio. And we're going to use pretty similar stats to what was shown on the spreadsheet earlier in the video. The starting yield is going to be the same at 2.44%. Before our dividend growth rate, we're going to be a little bit more conservative. Instead of that 8.2%, we're going to drop it down to 7%. I think that's maybe a little bit more realistic if we forecast into the future. And we're going to use the same exact share price appreciation over the years as well. And looking at the results, guys, after 20 years of investing $100 per week into this portfolio, you'd be left with about $275,000, just a few $100s shy of that. And across this time period, your annual dividend income would go from $0 to about $6,800, which is not too shabby. But then, guys, if we extend the time horizon just 10 more years and look 30 years into the future, the situation looks a lot better. There's a lot more growth just within those 10 years. We go from about $278,000 in the portfolio to $735,400, and the annual dividend income grows from about $6,800 to 3 times that amount, just above $18,000. And in those 10 years, in that time period, you can really see this portfolio take off. That's where the snowball effect really starts to kick in, and that compound interest really starts to take hold. Now, guys, as I was kind of saying throughout the video, I actually have a lot of the stocks that we talked about today in my own portfolio. I have Procter & Gamble, Starbucks, Visa, Johnson & Johnson, Chevron, and Realty Income. And in this next video right over here, I'm going to show you my position in these companies along with the rest of my dividend stock portfolio. We'll get into every single one of my holdings, including my number of shares, as well as my gain and loss with each position. So click right over here to check that out, and I'll see you in the next one.